Up some personal finance questions on the Personal Finance Corner. Lokesh Nathany of Motilal Oswal Asset Management joins us. Thanks very much, Lokesh. Lots of questions for you. Let's head across straight to Bangalore, where Mr. S.G. Basu is waiting by to ask his question. Mr. Basu, have you invested before? You're looking at investing in mutual funds, I understand. What's the kind of returns you're looking at? What's the kind of time frame are you looking at?
See, this is a very general question on diversified equity mutual fund. The time horizon is around 10 years plus. Investment, you can assume 10 lakhs plus. And the basic goal is that capital appreciation. Can I ask my question?
Sure.
Okay. See, I have it's a very general question. Two questions I have. One is that, what is the optimum number of mutual fund one should have in his portfolio? Considering two contradictory points. Number one is that if you have a less number of mutual fund, then the risk of the fund managers comes in picture. And if you have a more number of funds, that means more number of stock, the profit will be even out. So this is my first question. What is the optimum number of mutual fund one should have? Number two is that, when one should quit the mutual fund or take the profit on the mutual fund, it is that when fund performance comes from rating of 5-star to 4-star to 3 or 2 as per your money control or crystal rating. These are mainly my two questions.
Okay, Mr. Basu, I'm presuming that in your first question, 10 lakh rupees is what we are talking about, right? The investment. And that's a lump sum investment.
Yeah.
Right. Okay, Lokesh, if a person is investing 10 lakh rupees, roughly how many schemes should it be? I mean, to answer his question from the way I look at it, it should be an optimum size. Neither too many are good and neither too less are good, right?
Absolutely. I think I fully agree with you that, the portfolio size or the diversification should not be too much to handle and track, and it should not be too less to, create the concentration risk. See, if somebody is looking at, say, 10 lakh rupees investments into mutual funds, and I'm assuming that he's looking at equity mutual funds, I think one should be looking at not more than about 4 to 5 schemes, because today if you invest into good quality asset management company portfolios, 2 lakh rupees, if you look at as a percentage of their overall exposure into equities, I think will be still very, very small. So from an individual point of view, more than 4 to 5 schemes over 10 lakh rupees, I think will be asking for too much, because he needs to track those schemes, he needs to see whether they're meeting his objective or not. So I think 4 to 5 should be an ideal combination of various schemes on 10 lakh rupees.
Also, a second question that, when you invest in a fund, at what points of time should you be looking at exiting or cashing out from them? Of course, he's got a 10-year horizon, which is a very good thing. And my other question to you on his behalf is that he's 61 and he's got this corpus, he's looking at a 10-year window. Should he much rather do an STP and move in a systematic way, or put it all lump sum at this point of time, given his age?
Yeah. I think even though he is 61 and thanks to the medical advancement, today one is going to live to 85 or 90 years. So he still has about 20-25 years to beat inflation and generate returns. So I think at the age of 61, one should still have exposure into equities. However, depending on one's risk appetite, one decides how much exposure should be there. As a thumb rule, you can use 100 minus the age should be an exposure into equities. However, if your risk appetite is higher, I think about 40 to 50% of a portfolio you can have in equities even at 61 years of age. With regard to STP, I mean, even if you do STP, I mean, if you look at the average returns, since the money will be lying in liquid and then you are switching to equities over a period of time, so to that extent you'll be earning lesser in liquid till such time it's fully invested into equities. So I think if he is not depending on regular income and if he has horizon is 10 years, I think he can invest lump sum of 10 lakh rupees into equities. And coming to his second question about when do we book profits, I think this is a question which every investor keeps asking, saying that, okay, fine, I've invested, when do I book profits? I think, there is no right or wrong answer for this. I think the profit booking should happen under two circumstances. First, if the scheme in which you have invested or the asset class you invested, if it has met your financial goals, I think you must exit the strategy. If you don't need the money and you think that you've invested into quality portfolios, I think you should stay invested as long as you can. Just to give an example, let's assume you invest 10 lakh rupees with a goal, 10 years down the line that I want to buy a house, to give you an example. And at the end of 10 years, he has the money ready to buy the house. and somebody comes and says, you know what, markets are looking very good next 3 to 6 months, stay invested, probably you can buy a bigger house. It may so happen that actually his dream house remains a dream because the greed comes into play. So if your goal is met, I think you should exit. Otherwise, I think you should stay invested in good quality portfolios as long as you can.
Balani calls in from Delhi. Hi Rishi, what's your query today?
On MIPs, I do not have a stagnant monthly income as it is incentive based, and recently I've been investing in MIPs such as HDFC Reliance, Canara Robeco monthly dividend plans.
Okay.
I want to check if this solution can be good for my type of situation.
Okay, can you just repeat where all have you invested at this point?
HDFC mutual funds monthly dividend plans, Reliance, Canara Robeco.
Okay.
All
Rishi,
monthly dividend plans.
any reason, Rishi, why you're in MIPs? You're 33 years old. Why not other diversified equity schemes, for instance?
The reason is, as I said, that my income is not stagnant. I am, I work for projects which is on incentive base, and sometimes my income for that particular month goes up, and sometimes it comes down. So I need to have some regular income to meet my grocery expenses. I'm a married person with 3 kids.
Sure.
So I want to have something separate for them for regular flow of money.
Okay. All right, Lokesh, the point he's making is he doesn't have consistent fund flow, but it's coming and going, so he wants some stability. So MIP is where he's invested. You heard some of those schemes. He wants to basically know if he's on the right track, as far as I understood. Right, Rishi?
Yeah, thanks Rishi. I think, MIPs are the flavor right now. Everybody's talking about MIPs. But I think, Rishi, the good news is that you have a clear objective in mind. What I would advise is that monthly income plans, normally the income also is not fixed or regular, depending on the surpluses in the strategy that the fund house will give you dividends. So you may have months where no dividends are being given. So what my advice will be that since you know what is the kind of expenses you have every month and the kind of inflows you need every month, probably systematic withdrawal plan may work much better, because there you can decide an amount which you want to take out every month. So irrespective of the scheme performance, you take the amount. So give you an example, if you invested a lakh of rupees and you assume safely that 10% return will come every year. So you withdraw 10% every year divided by 12. So that's roughly about, say, 1,000 odd rupees on a lakh of rupees every month. So irrespective of the fund performance, you withdraw that 1,000. In a month when the appreciation is lesser than 1,000, some part of capital goes out. In the month when appreciation is more than 1,000, you still get 1,000. So over 3 to 5 year period, you will realize that you're not lost your capital, there's some appreciation, and you met your objective of monthly returns. I think that'll be more effective than just going for simple MIP, because there you are at the mercy of the market in terms of meeting your expenses.
Okay. That's the call coming in and your personal finance query being solved. We'll sit